Hello and welcome back. In the last video we talked about what are iceberg orders. Now in this video what we're going to do is we're going to actually look at the entries and how you can take advantage in much more detail so that you can start trading this idea today or tomorrow if you see a good setup. But before we do that, we're going to do a little quick recap about the previous video just to jog your memory, or if you're new to the video then you'll understand what we're talking about. Really the first thing that we were discussing was slippage and why that's a big problem, big nemesis if you like, for the banking industry. If a big bank wants to do business at, let's say, this level of support, let's call this price point 100, and let's say it's a really obvious level of support, and let's say they've got $30 billion to buy at that level, what will happen is rather than being able to just buy what everyone else is buying and they can just press the buy button and they'll get all that business done at 30 billion and the market will then follow through. What happens is if there's no sellers, then they can only get so much business done at that level before the market starts shooting away from the level. So for instance, they might be able to get 5 billion of that order actually done, but then by the time they've only done that 5 billion, the market's already up here at, let's say, 120. So now it's not where they want to do business, it's higher. And let's say they get another 10 billion done, and it's much higher again, it's up in this area, it's at 140. So it just becomes more and more expensive and it just can't work. They can't get all the orders done at the location where they want to do business. So it just can't happen. So that's why they're using essentially your stop loss orders and manipulating traders to come in off the sidelines and take some risk. How do they do that? Well, the other thing we talked about is where you place your stop losses, where your stops are, is very, very obvious, right? If you're trading off a level of support and it's been touched several times, once, twice, thrice, then it's very obvious where you're going to place your stop if you're going to be a buyer over here, because everyone's taught to do it that way. You'll start to see some peppering if you're able to see those orders below the structure like that, and that's where those stops are. So going back to the previous example, the banks know where your stop losses are. And the final part that we talked about, the mechanics really of the process, was the hard right edge. And what that is essentially the area on the chart that we all have, right? It's where the price is in the here and now, but it's the future price and it's what's coming into the future. But what traders don't do is they don't pay attention to what's coming into the future. They're just focusing on the here and now. So that's why this entire process collectively allows big banks and institutions to manipulate price and to get you caught and stopped out, and then obviously they get their business done, and unfortunately without you on board. So what we're going to do now is we're going to actually look at a setup and how you can take advantage of it. We'll use a level of resistance for a bit of a change. The last one was support on the other video. So price comes up to a level, it's touched once. Now it needs to be touched more than once, minimum of twice, so that you know that you've got a proper level. Price comes up to the level, and what you want to see at this stage is some type of sell-off. So imagine you get some type of engulfing candle at the level. Now it's not always the same, but you're just looking back historically and recognizing that that's a level that traders will want to trade. And you just really need to ask yourself, if I was going to sell off this level of resistance, would that be enough to convince me in off the sidelines? If the answer is yes, you've got the beginnings of a setup. Now then, of course, none of us know whether or not it's going to develop into a stop hunt or not. But what you've got to understand, an iceberg order essentially, which is a more complex stop hunt. But what you've got to understand is that this is how one begins. This is where a bank will do some type of manipulation. Now whether or not it happens or not is another thing, but what we're doing is we're just waiting. It's pretty pathetically simple really. We're just waiting and allowing all of this to unfold. So we haven't done anything, we've just witnessed that there's been some selling at the level. Now that could continue on, but it won't continue on for much more, maybe 1, 2, 3 candles perhaps, And all that's really doing is, when you see it working like this, don't worry, it's actually just convincing more traders in at this level who are going to sell, right? It's just becoming more predictable, more obvious. So sellers are piling in because, you know, they went short in here and it made them money, and some of them went short in there and it made them money. So it's just doing exactly the same thing again, and their hope is that it'll follow through. Now then, it's at this point what we want to happen. I'm running out of a bit of space, so we'll go and zoom in a little bit. You can see this a little better. So at this stage, so this is the level. We've had 1, 2, 3 candles in the direction of the move. It's at this stage that we're probably going to want to see some type of buy-in occur. So you get some buy-in, goes up through the level. Now it's at this point, as it's popping up through the level, that it's going to start causing a problem, obviously, for these traders. Now, where they're going to place their stops, right? You guessed it, just above the level. So all we're doing is we're just walking through the order flow. And again, we haven't done anything at this stage. We're just understanding that this potentially is the beginnings of the process. So as price goes up through the level, we know those stops are being triggered. And if you're a seller in here, then those stops equal buy orders. Now, if you're a big bank and institution, obviously, and you want to sell at this level, you're going to need a lot of buy-in to occur. So that forced buy-in's occurring, as we described in the previous video, because these people who sold there don't want to get stopped out, but it's unlucky, it's just occurring to them. So they're getting stopped out. But the next part that's occurring as this is popping up is this willing buy-in now coming in, because those breakout traders, right, will start going along. Why would they do that? Well, that's what breakout traders do, right? They buy at levels, especially well-defined levels, because the idea is that when it pops, it's really going to follow through. So we've got those 3 candles going up through the level, and this is where those breakout traders, as I said, will start going long, because at the hard right edge, they're not paying attention to what's coming. So they're just reacting off this break through this prior level of resistance, right? So they're going in now and they're buying. So what might happen next? Well, the idea is usually that when you get a situation, an image that looks like that, you'd anticipate price to retrace, and generally speaking, it will retrace back to the level that it had just broken out from. So you get some type of selling now back into that level. Now again, just like this was the tempting price action, the entry cheese that got these traders to go short, just like this was the entry cheese to get those breakout traders to go long, to buy, when it pulls back into here, this is the area where you would anticipate some buying to occur for those retracement traders to go long, right? It's entry cheese, making them believe that it's actually a break, pullback, and then the market would follow through and break to new highs. So let's go and take a look at that in a little bit more detail. So we are step by step inducing and seducing and manipulating this area. So I won't do the candles, I'll just do the pattern. And here we go, I'll just do one candle here. We get a big engulfing candle, say, at the level. And this is the moment where you want to pay close attention, because this is where ultimately this could be a complete and utter iceberg order completing, and this is our opportunity. Now again, we're not doing anything, we're just observing price action and understanding the order flow at the level. So we get this engulfing candle, maybe we get another candle going up, maybe we get 3. You probably wouldn't necessarily see it break out into a new high. You wouldn't necessarily want to see it go above that high. It can do, but if it starts to fail after 2 or 3 candles, that's ideal, because that's probably got all the break, pullback, retracement traders in that it needed to, and now this is where we've got that opportunity. So let's get into the bones of the entry. So it breaks up through the level like that. We've got 1, 2, 3 candles in the direction of the move. You get a big engulfing candle. Now I would watch at the level. Well, that engulfing candle could go down through the level, and if it closes quite a distance under the level where there's absolutely no there's no doubt that it's gone back below the level, then you can just take a short. You can sell there and place your stop loss above the stop hunt itself by, not by much, by sort of 5-10 pips, something like that. Not a great deal. And just take the trade. And you want to be looking for a minimum. Obviously I can't tell because I don't know the structures that you're looking at, but you want to go for a minimum of 2 times whatever it is that you're risking. So if you're risking 50 pips, if that distance from there to there is 50 pips, then obviously you want to go for 100 pips profit, and just use that metric all the time. You always want to be going for a couple of times whatever it is you risk. Now the reason why it can be slightly different for the entry is that you don't know whether or not you're going to get a big engulfing candle, but the point is, if it closes back under that level and it's convincing and you get one candle do that, fantastic. Now here's the next thing that could occur. You might just get price come back to the level, bounce once, go up once rather than the 3 candles, and then is followed by a big engulfing candle straight away after it. Again, that's a little bit nicer in some ways, because although there's potentially few people caught, so long as that's a decent engulfing candle, this second candle, this engulfing candle going down, really catches them quickly. So long as that is convincing enough, and then you get an engulfing candle that closes again, 10-20 pips below the actual level itself, then and make sure it closes near its own lows, then again just place your stop on the above the stop hunt itself, take the trade 2 times risk. The reason why, as I say, it's always the process is always the same, but it can present itself slightly different each time. Another version would be, you just need a playbook essentially to understand what to do in the different circumstances, and that's what we're trying to explain now. Another example would be, you get a positive candle, you get a couple of negative candles go under, you're maybe not too sure about it. Well, then you want to wait for one positive candle and then a negative candle, and then again, same again, wait for the close, put your stop above the stop hunt itself. And the reason why I'm saying you want to go above here is because if you just think about it, the institution that has manipulated this level is not going to come all the way back with the greatest respect in the world for your order. It's just not big enough. So it's unlikely that it's going to come back. Now, of course, what can sometimes happen is it can take another swipe up before it fails. But at this point, we have an edge. And if it does do that, and potentially you get stopped out and you get back in this similar situation, you can take the trade again. So you can literally do this twice, because it's not a situation where you're over trading per se. It's just that if it does go back up, what's the reason for that? Well, they didn't get enough orders fulfilled at the levels, so they need to induce more buying so that they can get off that additional selling. But we never know that it might come back for that second touch. It's impossible to know whether it'll come back for that second look. So we've got the edge when we've got the edge, and we just take the trade accordingly. So what you're looking for is a failure to go up. And if you get some type of engulfing candle or a break, pull back to the underside of that level itself, so it pops up through the level, bounces, catches them, breaks down through the level, then comes back into the level and sells off, then again, this is where you can go short and place your stop on the other side of the stop hunt, itself. And this is really just one manipulation, guys. I've uncovered over 20 over the years, and if you'd like to come and learn more in my brand new inner circle, then click on the button above or below this video. I'd love to see you on the inside. Take care.